Ladies and gentlemen, good day and welcome to the H1 FY24 results conference call of Krishca Strapping Solutions Limited, hosted by Kirin Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kaushal Shinde from Kirin Advisors. Thank you, and over to you, sir.
Thank you. On behalf of Kirin Advisors, I welcome you all to Krishca Strapping Solutions Limited H1 FY24 con call. From the management side, we have Mr. Lenin Krishnamurthy Balmanikandan, Chairman and Managing Director. Now I hand over call to Mr. Lenin Krishnamurthy Balmanikandan. Over to you, sir.
Yeah, thank you, Mr. Kaushik. Ladies and gentlemen, very good afternoon. I will start with the opening remarks. My heartfelt welcome to everyone who have joined in this conference call, where we come together to talk about the financial performance of Krishca Strapping Solutions Limited for the first half of this fiscal year 2024. It's truly an honor to speak with all of you. Before we dive into the details of H1 FY24, let me give you a quick overview of our company and how we operate. Krishca Strapping Solutions started FY24 on a very brighter note by making a revenue of 48 crores and 89 lakhs. That's almost two-thirds of what we done in the last financial year, FY23. We are proud of the strong growth we have seen so far and are looking forward to an even better performance in the second half of FY24. We are working very hard to improve our financial results and are very excited about the opportunities coming in our way. On the operational side, we have made good progress by strengthening our relationships with many clients. This not only helped us sell more, but also brought new clients, showing that we are committed to growing steadily. Though our profit margin went down slightly compared to the previous year, it's mainly because we are in a phase of aggressive growth and expansion. We strongly believe this strategy will pay off in the long run. Looking ahead, we expect our growth to continue strongly with a substantial growth rate of 35 to 40%. I take this opportunity to share with you that we have successfully bagged our first packing contract from Sham Metallics worth 2 crores. This contract is a very big deal for us since earlier we were not having any eligibility criteria in the packing contract segment. This is a renewable contract, setting the stage for a long-term partnership with Sham Metallics. And we are also pleased to confirm that we have secured our first packing contract with PSU, Sale Authority of India, SAIL. This contract is effective till October 31st, 2025, with an initial value of 2 crore 48 lakhs. These two contracts, put a strong foundation for our packing contract division, which we expect to grow in the coming months. We are growing, and now we decided to increase our footprint globally. So we have recently set up 2 new offices in Dubai and Singapore. In September 2023, we started Krishca Total Packaging Solutions, a pre-owned company in Dubai, UAE. This strategic move allows us to diversify our product portfolio, now including primary packaging items like tarpaulin, HTP, Dana jet bags, desiccants, and VCI corrosion protection products to the steel industry. We are very excited about the opportunities this expansion brings to our customers in the UAE and in the Middle East region. And in October 2023, we established Krishca Total Packaging and Preservation Solutions in Singapore, marking another milestone in our global presence. This move positions us to better serve our customers in Singapore and Southeast Asia offering tailor-made packaging and preservation solutions. While we have our strategies in place to grow in domestic as well as in global markets, we need to increase our capabilities to meet the rising demand for our products in India. So we are upgrading our production capacity to make to produce more steel strapping. So we are installing a new production line, which is more modern and will be able to produce 20,000 metric tons of steel strapping per annum. This new line is scheduled to commence installation by end of November 2023, and this new line is expected to be fully operational by the end of January 2024. And apart from this, our team in Krishca is also working on creating a mobile app for our sales team to support with all the relevant information to meet the customers. So this app will give them all the info and tools they need to serve the customers even better. With this new initiative, we are in the position to gain a higher market share in the domestic as well as global market. At the same time, the increasing share of our packing contracts will help us improve our EBITDA margins in the coming months. Let me quickly take you through the financial performance of the company during the first half of this financial year. Our total revenue was at 48 crores and 89 lakhs. This is about 67% of last year's revenue. Our EBITDA came at 8 crore and 36 lakhs, and the EBITDA margin was at 17.1%. Our net profit was at 5 crore 68 lakhs, and the net profit margin was at 11.61%. Our earnings per share was at 10.23 rupees. The robust performance is the reward to our hard work, our effective growth strategies, and operational efficiency, and nonetheless lucrative market opportunities which we capitalized during the reported period. We are very optimistic about the future growth opportunities, and with enhanced production capabilities, product and regional diversification, we would continue to ride on the growth path with more confidence. At this point, I would like to assure you the future is very lucrative, and our company will do every effort to optimize profit from it. I am grateful to you for all the shareholders and well-wishers, our associates, for your faith in the company and being an integral part of our company. With this brief update, now I would like to take any questions you may have. I request the operator to kindly open the floor for Q&A.
Thank you very much, sir. Thank you. We will now begin the question and answer session. Anyone who wishes to ask questions may please press star followed by 1 on their touchtone phone. If you wish to withdraw yourself from the question queue, you may please press star followed by 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take the first question from the line of Rahul Dasani from Mittal Analytics. Please go ahead.
Yeah, am I audible?
Sir, the audio is a little bit low. Can you please increase the volume?
Is it better now?
Yes, sir. Please proceed.
Okay. So, first of all, good morning, sir. I had a few questions.
Yeah, hi, Rahul. Good morning.
What are the steel strap prices right now? Because previously you have said that you operate on a fixed margin level, and if the prices fall, your margins may remain the same, but the absolute EBITDA will fall. So first of all, how are you thinking about this? Because on the surface, the margins may seem good, consistent at 17 to 19%, but the bottom line can be severely impacted.
Yeah. Okay. See, currently the steel prices are on an uptrend. Compared to the first quarter, the last 3-4 months, steel prices are on the rise. And right now, our average steel price is around 70 rupees. So we are, our average selling price would be about, 90 to 95 in that range.
Okay, but are we taking any measures to somewhat safeguard if and when the prices take a hit?
Yeah. See, our sourcing policy is very good. We have a long-term contract with some suppliers, where they are giving fixed pricing for 6 months. And some suppliers, we have a quarterly contract where they are maintaining the price for every quarter, 3 months. And there are a couple of suppliers we are importing also. So whenever the price is low, we book it, so we can able to get a good margin on that. And of course, whenever the price falls down, we have some spot suppliers where we can buy on the current running price. So we have, several different kind of purchase agreement with several different suppliers. So based on the current pricing fluctuation in the market, our sourcing team, we take a call to optimize our purchase cost.
Okay, got that. Secondly, what has your volume versus value growth been throughout the years, including the current years? And where do you expect it for the 40% growth target for the next 5 years?
Right now, at our factory, we are utilizing almost 65% of our installed capacity. Okay. With the, on 100% utilization, we can do up to almost 130 to 140 crores in the new current line we are having. Since we are already doubling the capacity, we are putting up a new line. With that, on a 80-90% utilization, we can go up to, comfortably 300 CR. Because we not only supply steel straps alone, we supply steels also. So we have 80 million numbers of steel installed capacity. So almost our 5% sales we are getting from steels also. And we supply these packing tools also. So with the installed capacity we will be having by the end of January, we can do up almost 300 CR of only steel strapping sales. But now, in the recent past, we secured 2 contracts, packing contracts. So in the packing contract, the steel strapping value will be 30 to 40% max. Remaining 60% revenue will be getting from other items or by supplying manpower, etc., etc. And earlier we were not having any eligibility criteria in the packing contract. Now we have 2 contracts. We are expected to start one more contract by December. That announcement also we will release once we start. Our team is participating in almost 6 to 7 big contracts, much bigger than what we are currently doing. So we are expecting our revenue, high revenue from the packing contract division in the future. So in the next 5 years, we are very positive and confident that 30 to 40% increase year on year is very much achievable. Since we already have the capacity to do that, we have a good team to do that, and there's a good market also scope also there. So I would say it is very much possible.
No, sir, that was helpful. But my question was, what has been the volume versus value growth? I wanted to understand, since you said the prices are on an uptrend, so I wanted to understand what part of the sales is coming through volume growth and what is coming through value growth, just to understand the sustainability.
See, what do you mean by value growth? Can you be
value growth? By value growth, I mean the increase in the prices of the product, steel straps that you are selling, and by volume growth, I mean the number of in tonnage you are selling.
See, there has been no change in the price we are selling, because most of the contracts currently are long-term contracts. Okay, so whatever, and since we are growing on an aggressive pace of growth, we are not able to increase our margins, selling price. So whatever is the current market price we are entering, because most of the orders we are getting are first-time orders or first-time packing contracts. So our major focus is volume growth. At the same time, we will maintain the current selling price. We will try to maintain that.
Okay, that was helpful. Secondly, you said that you are at 65% utilization at the current plant.
Yeah.
So I wanted to understand what's giving us the confidence to expand our capacities by 2x while we are running at lower capacity. Like, do we have any firm contracts or firm order commitments for the expanded capacities that we are building?
See, in steel strapping, there are four types of steel strapping. One is the regular duty, one is the medium, one is high tensile, the other one is the very high tensile. It's a new trend in the market where they are giving UPS more than 110. So at our current facility, we are producing the first three grades. The latest grade, we are not able to produce with the existing facility. The new line is specially designed for, producing this ultra high tensile strapping where the UPS is more than 110. Now I am seeing, quite a lot of migration, customers are migrating from high tensile to ultra high tensile strapping. So, that's why we are doing this expansion. And, since that earlier we were not supplying that one grade, after the installation of new line, that market is also will open up. Almost 30 to 40% market share now using this ultra high tensile strapping. So the capacity expansion is to serve the new market, especially. And to answer the other part of the question, yes, we have some kind of a commitment already in place for the new line. At least we can able to sell some, minimum 4 CR worth of products month on month immediately upon commissioning of the new line.
Okay, and lastly, you said the plant will be fully operational in Jan. So by when can we expect 100% utilization or whatever is the optimum utilization for the plant?
Within maximum 1 year, we are expecting at least 40-50% utilization in the new plant.
40 to 50%, right?
Yeah, correct.
Okay, and I was looking at your asset turns in comparison to your peers. They are significantly higher. So can we expect the same asset turns from this new plant?
Yes, we can.
Okay, and are the margins, can you give how higher are the margins compared to a current 17 to 19% average for the new plant?
So in terms of margins, it can be slightly better because there are some customers offering, higher, ready to offer a higher price since it's a higher grade of steel strapping. There is a possibility to get a higher margin, but since we are not selling at all, it's difficult to say, but it won't be less than the current margin. Definitely it will be higher than the current margins.
Got it. I'll get back in queue. Thank you for answering all my questions.
Yeah. Thank you, Rahul.
Thank you. The next question is from the line of Nikhil Chaudhary from Chris PMS. Please go ahead.
Good afternoon.
I'm Nikhil. Good afternoon.
Yeah. Hi. So, Bala wanted to understand our Dubai subsidiary. We had given a logic that probably there are no players in the market and duty benefit is there. Singapore, what was the rationale? What is the rationale for setting up the Singapore entity? What sort of competition do we get in Singapore market? Do we have Chinese players supplying? What sort of opportunity is there? Can you just throw some light on the market that has been recently announced?
Yeah. So the Singapore company's name is Krishca Total Packaging and Preservation Solution. So apart from offering total packaging, we can also offer corrosion protection solution. Because in steel packaging, there are two aspects. One is strapping, which is used for packing the steel, and the other aspect is to protect the steel from getting in touch with moisture or water. For that, we offer a primary packaging solutions. We just started offering that solution. So,
okay, so
along with that,
new solution.
Sorry, can you say again?
That is a new solution. Like probably I lost you in between. Like, is it steel strapping or something else that you are going to do?
No, it is part of packing contract. When we offer a packing contract, steel strapping is one item. Apart from that, we also have to supply HTP, tarpaulin, other items to prevent the moisture or water getting in touch with the steel. That we are already doing part of Krishca. But there is one big contract is coming in Singapore that is for a preservation of a big, oil and gas project. To participate in that project, there was a requirement that we should have a local company. So that is the reason we formed that subsidiary in the first place.
Okay. And is it similar, like, what sort of competition do we have in steel strapping in Singapore? Like, or do we probably have the Chinese players getting in that market, or what sort of competitive intensity is there?
So, Singapore, in terms of steel manufacturing, they are not, there is not many steel mills. It is mostly a primary packaging market. And in terms of competition, yeah, of course, the Chinese player also there, but they prefer, more Indian products than Chinese because of the quality, and the price is not a big factor in Singapore. They look for a good quality consultation in terms of product offerings.
Okay. And also, Dubai entity, we are currently doing only trading, right? Like, it is only trading entity.
Yes, right now it is a trading entity.
Okay. And what sort of revenues can we expect in 24 from the Dubai entity?
So at least we are expecting 20% of our revenue from the Dubai entity the next financial year.
Okay. And when do we plan some manufacturing base over there, or will it be like a trading entity, something with that going forward too?
We are doing our market research. We will definitely come up with our plans very soon.
Okay. Got it. Understood.
Yeah. Thank you, Nikhil.
Yeah, just a second. One last question.
Okay.
What percentage of the order book is in the high grade tensile, the steel straps, current order book?
See, our new line will be operational only in January, but we have some kind of commitments from our existing customers and new customers. At least 30% of our order book will be of this new grade from once we install.
Which segment will that be? Can you just explain that?
No, it is all the customers are using based on the application. Even in glass, it is being used in mainly steel, and also in Kolkata there's a jute segment. That jute segment especially is this grade particularly.
Okay, got it. Understood. Thank you so much. I'll come back in the queue.
Yeah, thank you, Nikhil.
Thank you. The next question is from the line of Akshita Deo from Vivo Commercial Limited. Please go ahead.
Okay. So what I wanted to know was about the PSA contract which you just mentioned, and what kind of and what is the exact vision behind the company getting into packaging, and what type of margins are they also expecting? Because you mentioned that because getting into packaging, you'll probably get better margins. So yeah, that's my question.
Yeah. Thank you, Akshita. See, the logic behind getting into packing contract is that packing contract as a segment is much bigger than direct supply of steel strapping, and most of the companies are they are migrating towards packing contract, because what happened in packing contract, they are arriving at a % packing cost, and they are maintaining their cost will be the contracted scope, and mostly it is long term. Minimum 2 years, up to 5 years. So the major logic behind focusing on more contract is that it is a long term order. So once we get it, at least for 2-3 years, we can say our order book will be full with that particular order, and even the value of order also very high. Instead of giving the pricing month on month and getting the order, having a long term and stable order is preferable. And there are if you don't go into packing contracts, almost 50-60% of the market they are doing the packing, or much of steel strapping happens via packing contracts. So we will lose our direct strapping sales. So to boost our direct strapping sales also, we are preferring packing contract.
Okay. what kind of margins are you expecting from packing and the overall boost to the company?
See, currently we are expecting similar margins. There is a chance to optimize it. The thing is, once we doing the same kind of packing over and over on a long-term basis, we can optimize and try to get better margins as we start the contract. But initially, margins will be similar because we are incurring a lot of manpower cost to set up the project. We're investing a lot of machinery, items, everything. But over the years, margins will, get better.
Okay. And can you tell me about the PSU contract that you were mentioning about the order value and if it's renewable or not?
Yeah. See, it is a packing contract in a refractory unit. Say Bokora has a refractory unit near Bokoro. So for packing that we are taking a contract. The order value, which is almost 2 crore 48 lakh, that is for only 1 year. But the contract validity is still October 2025. So, and they might extend this beyond that point also.
Okay. Have you done the payback period calculation of opening the offices in Singapore and Dubai, and how quick would it be for them to become profitable from the get-go? And what kind of investments you had to occur for starting up these offices?
Yeah. See, we are very cautious, making any investment or expenses. In Dubai office is purely a trading office. We did a company registration in a pre-zone. There is and two of our employees are working from home only currently. Okay. There is so there is actually not much investment made. Only we opened a bank account and office registration has been done. All the orders we are selling from Krishca India to the customers directly. So it is profitable from day one. Krishca Dubai. In Singapore, we just recently did the registration, and we haven't appointed anyone in Singapore. So the objective is to participate in a tender. So if we get a tender, then we will put up a representative over there. So we are not incurring any other additional expenses in Singapore office, apart from the initial incorporation expenses.
Okay. And so by the end of this year, how much will your total capacities be for steel scrapping plus packaging?
Sorry, can you repeat your question again?
So you're doing a 20,000 metric ton of capacity expansion, right?
Correct.
So what will your total capacity be for steel scrapping as well as, your total capacity by the end of the year?
Okay. It will be roughly 40,000 tons.
Sorry, sir, how much?
40,000 tons.
Okay, sir. Thank you so much. That's all from my side.
Yeah. Thank you, Akshita.
Thank you.
And all the best.
The next question is from the line of Suruchi Parmar from NX Wealth Management. Please go ahead.
Hello. Good afternoon, sir.
Hi, very good afternoon.
I would just like to have a clarity on your packing contract. Like, how is it built up? Like, there should be some products involved in that. You are just scrapping the product you make, and the service part, on how is it the whole contract is used?
So in a packing contract, there are three things mainly required. One is the manpower who will do the packing, and tools. In steel industry, steel scrapping is done by a scrapping tool. So all the like cutters, other items, accessories, all are required in the packing contract. So we have to identify the manpower, right tools, and the consumable. So one of the major consumable is steel scrapping. That is a major consumable. Apart from that, based on the type of item, other items also required. So right now, scrapping tools we are already dealing that we will deploy from our side, and the scrapping anyway we are manufacturing will supply. Manpower and other consumables, everybody is sourcing from outside. So with our expertise, we will suggest the right consumable which can have a cost saving to the customer. That's how we are putting a basket and giving as a solution.
Okay. So is there any idea to go into production of these tools later in your future? Any idea of getting into making of these tools?
You mean heat strapping tools for manufacturing?
Correct. Yes, yes.
Right now, we have no such plans.
Okay. Okay, thanks. And sir, you have talked about, like, in your last con call, regarding the Dubai office. So in later years, you will be putting some production line in Dubai also. So is there any change in your plan, or what you feel like the market there, what you are supposing to cater to US market also? What are your plans to that?
We are doing a very serious research right now in the Middle East region because in Middle East has like Saudi is there, Oman is there, Dubai, I mean Abu Dhabi UAE is there, and Bahrain also it's a good location because they have a stay with the US. So we are doing a in-depth market research. So based on that, we will come up with some announcement very soon about our decision and our future plans.
Okay. Okay. And what are the current exports percentage in your revenue?
If you look at the half year, out of 48 year, almost 4.5 year was exports, almost 9-10%.
Okay, fine, fine. So you are going to increase these exports later in the second half. You are expecting the exports will increase.
Yes, already in the October, November, December, I think we surpassed the export we have done in the first 6 months. So the second half export share will be higher, much higher than the first half.
Okay. Okay. Any like percentage you can decide on how much can it be? More
very hard to say, ma'am, but it is definitely more than 10%.
Okay. Okay. Fine. Okay. Thank you so much, sir, for answering my question.
Thank you. The next question is from the line of Pratik Kulkarni from Kamaya Kya Wealth Management. Please go ahead.
Hello, good afternoon, sir.
I'm Mr. Pradeep. Good afternoon.
Yeah, so I just wanted I just had a few questions that our cash flow from operations has been reduced quite a bit, has been a negative. And the key reasons for these I can see are the increase in trade receivables and the increase in other current assets. So what exactly is the other current assets?
The increase in other current assets. Okay. See, what happened, our auditor has grouped the advances we are given for the new line, almost some 7.5 year advances we have made, and that has been grouped under other current assets. That's why there is a very steep increase, and we have paid some income tax, advance tax. Even the advance tax also grouped under the other current assets.
Oh, okay.
That's why it is 10th year. But once the new line is installed, it will be capitalized under plant and machinery.
Okay. And same for the trade receivables. Are we seeing any increase in the credit line for customers?
See, some trade receivables, we were having almost 19 CR. The major reason is that there was almost 11 crore sales happened in the month of September. Especially in the last week, we made almost some 4 CR billing. So that is the major reason for jump in the receivables. But when we look at the current receivables, it is very lesser than what we given in the balance sheet.
Okay. Yeah. Okay, sir. That's from my side.
Yeah.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. We'll take the next question from the line of Darshil Zaveri from Crown Capital. Please go ahead.
Hello. Good afternoon, sir. Hope I'm audible.
Yes, sir.
Yeah. I just wanted to ask two questions. One is that, regarding the margins, what trajectory should we see currently? Because we said we are being aggressive right now in terms of pricing. So, how do we see that growing out? Like, currently, that phase will continue because we want to make a more dent, and that's why our margins will be around 16% right now, or it will journey upwards as we do more high densile products, or, any sense of that. So,
Good afternoon, Mr. Darshan. See, we are doing everything to maintain these margin levels, whatever we have done. The last year, it was like 12.7, and now it is 11.6. That is our PAT. So there was not much serious dip currently, and we will try to maintain at this level. At the same time, since we have the higher capacity, new team, we have to focus on the top line also. So our objective, go for higher revenue growth while maintaining the similar margins. And of course, once we reach a certain point, margins will definitely automatically will increase.
Correct, sir. And so just wanted to get a sense of this, like in terms of we are planning for 35-40% growth in our business. So just wanted to get a sense of, in terms of domestic, what would be the max market share that we will be able to gain? What is the market size? And I think we have two other major players around, and we are also entering a segment that's totally untapped for us, a 30-40% segment of the market. So just wanted to get a sense that with such a high growth rate, will we be able to exhaust complete domestic market? And how does then packaging come into play, so that, is that the vertical that, we'll be supplying in the same market share, or that is another whole new world on its own? So, just wanted to get a brief sense about that. Like, our growth rate targets are very high, so will we exhaust the market completely in terms of how much level that we can reach, or that the market's also expanding, or so something just more in terms of our markets and our target audience for that market and market share that we want to be?
Yeah. Mr. Darshan, if you look at the Indian market, currently it is growing at a very higher rate. Especially the steel industry, I'm seeing a lot of capacity building with the existing steel major companies like Tata. Everybody is under capacity increase, and there are many medium and small players also entering the market. So market itself, it is increasing at a very higher rate. That is a very good thing. And secondly, now we are, as per our estimate, we must be having some, up to 10% market share. And definitely it will increase. So I would say, capturing even 30-40% market share is a very good thing in this industry. Definitely we cannot do 100%. That is not a good sign, and that will be like a monopolistic scenario. 30-40 years back, that's how Signal was my competitor. Almost 100% share they are having. Now they are limited to only, I think, 45-50%. So, and now since market is open, global players also coming in. So definitely, doing more than 50% is a very big challenge. But our focus is, we are also, looking at diversification. Right. So packing contract is one thing. We are also now focusing on preservation and supplying primary packaging to other industries. So we are also diversifying. We are not only confined to steel industry and scrapping industry. As we grow, definitely our solutions offerings will also get mature, and we will start diversification into the similar line of industry.
Oh, perfect. So, and if I may, just one more question. So we're saying, we've done fantastic revenue right now in H1. So that we would maintain with our existing capacity, and another 12 crores that we would probably get from our new plant, right? So is that the right way to look at it?
Yeah, subject to, the successful commissioning and the installation. Yeah. Yeah, you are factoring whatever I said and telling 12 crores, but We are positive, very confident that it can happen.
Oh, perfect. So just wanted to say thank you and congratulations. It's one of the better calls that I've heard. All the best for future growth. Thank you.
Thank you for that, Stan.
Thank you. The next question is from the line of Chandru, an individual investor. Please go ahead.
Yeah. So my first question is on since our working capital and cash flow limits are already stretched, so the January, the new line is going to live. So how we are going to manage the working capital since we are buying our raw material on 100% cash? I think you mentioned like we are following bill discounting method for managing the working capital. So can you throw some light on that? And going forward, any improvement in payable days?
Hi, Chandru. Good afternoon. See, we got a new working capital limit from HDFC, which we got, I think, first week of October. So there is some 6 to 7 crores of additional limits we already got from our HDFC bank. And till now, we are not doing any bill discounting. But my finance team is actively in discussion with some 3 or 4 bill discounting companies. So by the time we install the new line, there will be some kind of facilities via bill discounting. So we can increase our working capital by up to 10 CR from whatever shown in the account balance sheet, either by CT or by bill discounting.
Okay, sir. Regarding the payable days, like our competitor Signode is having like a 120 days. Of course, they are divergence with our production when compared to Krishca. So, is there any scope for increasing the payable days going forward?
As we take more packing contracts, the receivables days I think will increase by 30 days. Because in packing contracts, the working capital cycle is, higher by 1 month.
Okay, sir. I am asking for the payable days, sir. So we are buying the raw material on 100% cash. So is there any credit going for?
It is possible. We are already in discussion with many suppliers for channel financing. And also, many people are inclined to give credit to us. As we have established credentials, long-term, relationship with them. Definitely, it is possible in the next financial year to get some kind of credit from our suppliers.
Okay. So my second question is regarding the welding segment. So you mentioned like you are looking for some investments in welding business. So can you throw some light on what is the business, what kind of opportunities is there regarding the competition level, etc. Yeah.
Right now, we have decided not to, do any investment in welding currently. That project is on hold because we are, fully occupied with this steel strapping expansion, and already we are focusing a lot in the overseas subsidiaries. So now our focus is mainly on the packing contracts and expanding the strapping business.
Okay. So my last third question is only regarding the packaging business. So I heard something like Signode is very nowadays focusing mainly on packaging business. So how we can differ and how can we compete with the big player like Signode in packaging business going forward?
See, they are from day one focusing on packaging business only, not now. They are the one established packing contract thing in India. So, see, for example, we got this Sham Metallics packing contract. That is even for Sham Metallics, first time they are doing. Earlier they were packing with binding wire. So we are focusing on a new customer. We're not focusing only on the existing contract. We're also trying to convert the current packaging style also with our existing offering. So our focus and strategy is definitely different from Signode. So definitely we can also able to get market share. And once we get eligibility criteria, and there are some PSU tenders happening in packing contract in Billai, and various steel plants are doing packing contracts So that is open forum. Whoever is giving best pricing and offering, they will get the contract. So opportunities are there for us also to grow.
Okay. Okay. So these are all my questions. Thank you.
Yeah. Thank you, Chandru.
Thank you. Ladies and gentlemen, this will be the last question for today, which is from the line of Shyam Desai, an individual investor. Please go ahead.
Hi. Thank you for the opportunity. So I just wanted to ask two questions. First is, if I correctly heard, you mentioned that packaging contracts are larger than the strapping business. Is it so?
Yes, we believe so.
So what may be the market size of the strapping business itself in India?
Including the packing contracts, it would be almost 3,000 crore.
No, I couldn't get you. I'm sorry.
Including the packing contracts on the strapping sales, it would be almost 3,000 crores per annum.
Okay. And if we break it into either of the two, should be half and half, or?
No, I would say 35% would be direct sales, 35 to 40%. The remaining 60% would be packing contracts.
Okay. Great. And so can I assume going forward 3 years, 4 years down the line, what you're talking about, the 30-35% revenue growth, there will be a point of time in next 4 years that the packing contract revenues will be more than the strapping solutions?
Yeah, that is what we prefer also. That is very much better in terms of order book and stable sales. That is our aim. We wanted to increase the share of packing contract more than 50%.
Okay. And my last question would be, is it possible to do breakup of this whole, let's say if I take 5-year period and 30-35% revenue growth for the same period of time, is it possible to provide breakup of all the activities because we are including the other activities?
This is a very sensible thing to share in the open forum. Maybe you can get in touch with our IR, Kirin. We can discuss over a face-to-face meeting if you are interested.
Sure, I understand. Thank you so much. That's it.
Thank you. Thank you, Mr. Shyam.
Thank you. Ladies and gentlemen, as that was the last question, I would now like to hand the conference over to Mr. Kaushal Shinde for his closing remarks. Over to you.
Thank you, everyone, for joining the conference call of Krishca Strapping Solutions Limited. If you have any queries, you can write us at info@kirinadvisors.com. Once more, thank you, everyone, for joining the conference.
Thank you very much. Ladies and gentlemen, on behalf of Kirin Advisors, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you, everyone. Thanks for joining.